You know the stock is down 40%. You know deep down it might not recover, and you're still holding it, telling yourself, I'll sell when it comes back. Here's the psychology that's quietly costing you thousands, and it has nothing to do with the market. This isn't stubbornness. It's a documented psychological law called loss aversion, first proven by psychologists Daniel Kahneman and Amos Tversky, and it's one of the most replicated findings in behavioral economics. Their research showed something strange. Losing $100 hurts roughly twice as intensely as gaining $100 feels good. Your brain doesn't treat gains and losses as equal opposites. It treats losses as a threat to survival. So when a stock drops, selling it means officially confirming the loss, making it real, permanent, undeniable. Your brain would rather avoid that pain entirely, even if it means holding an investment that keeps bleeding value every single day. Here's the part that should worry you. Studies tracking real trading accounts found that investors hold their losing positions, on average, twice as long as their winning ones. Not because the losers were secretly better investments, because selling them hurt more. That explains why you can't let go of the loser sitting in your portfolio. But the same fear is doing something just as damaging to your winners. This is called the Disposition Effect, and it's the flip side of the same coin. The fear of watching a gain disappear makes people sell their winning stocks far too early, just to lock in the profit before the market can take it back. It feels responsible. It feels smart. But the data tells a different story. Investors who study this pattern consistently find that the stocks people sell for a profit tend to outperform the stocks people keep holding at a loss in the months that follow. In other words, the exact instinct that feels like discipline, sell the winner, keep the loser, is often the opposite of what builds long-term wealth. You're not protecting your portfolio. You're protecting your feelings twice in two different directions. Fear of loss and fear of regret both come from emotion in the moment. But there's a third trap that isn't emotional at all. It's a number stuck in your head that has nothing to do with reality. Most investors mentally anchor a stock's true value to whatever price they originally paid for it, not to what it's actually worth today, and not to what it's likely to do next. I'll sell when it gets back to what I paid is one of the most common phrases in investing, and it sounds reasonable. But the market has no idea what you paid. It doesn't care. That number exists only in your head, yet becomes the invisible finish line you're waiting for, sometimes for years, sometimes forever, while the underlying business keeps declining. This is anchoring bias, and it turns your own purchase history into a trap that has zero relationship to the stock's future. 3 different traps, 3 different moments: buying, holding, and deciding when to sell. But they all come from the same root: your brain evaluating decisions based on how they feel right now, not on what the numbers actually say. Fear of loss, fear of regret, and an anchor to a number the market has already forgotten. None of this is about intelligence. Some of the most successful investors in history built entire systems specifically to override these instincts, not to eliminate them. Because you can't delete them, you can only outdesign them. Before you buy or hold anything, ask yourself one question: would I buy this today at this exact price if I knew nothing about what I originally paid? If the honest answer is no, the only thing keeping you in is the anchor, not the investment. Follow for more money psychology.